Did you know that the 2008 economic crisis is still impacting us today, over a decade later? What began as a collapse within the housing market soon spiraled into a global financial meltdown, but the ripple effects didn't stop there. They spread out, touching every aspect of our lives, from the job market to the national debt, and they're still being felt today. Intrigued? Stay tuned as we dive into the timeline of the 2008 economic crisis and its aftermath. To understand the long-term effects, we first need to understand how the 2008 economic crisis began. It's a tale of risk, ambition, and oversight that set the stage for a financial disaster. The stage was set in the early 2000s when the housing market was booming. Home prices were on the rise and everyone seemed to be buying. The dream of owning a home became attainable for more people thanks to subprime mortgages. These were loans given to individuals with poor credit scores who would have otherwise been unable to secure a mortgage. Lenders, blinded by the prospect of higher interest returns, handed out these loans like candy on Halloween. But there was a catch. These subprime mortgages were often adjustable rate, meaning the interest rates could skyrocket after an initial period. Many borrowers found themselves unable to keep up with their mortgage payments when this happened. Yet, this risk was largely ignored, both by the borrowers, enchanted by the dream of home ownership, and the lenders, seduced by the prospect of profit. Parallel to the subprime mortgage boom, risky financial products were being churned out. Lenders bundled these risky mortgages into mortgage-backed securities and collateralized debt obligations, selling them off to investors. These complex financial products were ticking time bombs, their true risk concealed by layers of financial jargon and high ratings from rating agencies. Meanwhile, a lack of regulation allowed these risky practices to go unchecked. The financial industry was like a car speeding down the highway with no speed limit, no seatbelts, and a driver high on the thrill of the ride. The government, which should have been the traffic police, was instead the cheerleader, encouraging this reckless behavior with lax laws and oversight. The result was a precarious house of cards, built on risky loans, complex financial products, and a lack of regulation. For a while it seemed stable, even prosperous. But it was a facade, a bubble waiting to burst. And then, in 2008, the bubble burst. In 2008, the financial world came crashing down. This wasn't a minor stumble or a brief falter. No, this was a full-fledged, earth-shattering collapse that sent shockwaves around the globe. The ground zero for this economic earthquake was none other than Wall Street, the financial heart of the United States, and by extension, the world. One of the most significant events of the crisis was the fall of Lehman Brothers. This titan of the financial world, with a history that spanned more than 150 years, filed for bankruptcy in September 2008. This was the largest bankruptcy filing in US history, and it sent shivers down the spines of investors worldwide. The fall of Lehman Brothers was a clear testament to the severity of the crisis. It was a wake-up call to everyone that if Lehman could fall, then no one was safe. But the crisis didn't end there. The stock market, the barometer of the economy, also took a massive hit. In the weeks following Lehman's bankruptcy, the Dow Jones Industrial Average experienced some of the largest single-day point drops in its history. The market was in free fall, and every drop felt like a punch in the gut to investors. Panic was widespread, and there seemed to be no end in sight. To combat this, the US government stepped in with a massive bailout plan. The Troubled Asset Relief Program, or TARP, was implemented to purchase toxic assets and equity from financial institutions in an attempt to stabilize the economy. It was a Hail Mary pass, a last-ditch effort to prevent the total collapse of the economy. But despite the government's best efforts, the damage was already done. The economy was in shambles, and the repercussions of the crisis were felt by everyone. Millions of people lost their jobs, and countless others saw their life savings disappear overnight. The financial landscape had been irrevocably altered. The crisis was over, but the damage was done. And the wounds inflicted by the 2008 economic crisis are still being felt today, more than 15 years later. The 2008 economic crisis left a lasting impact on the American economy. In the immediate aftermath, the country was plunged into a deep recession. The crisis, which originated from the collapse of the US housing market, spread like wildfire across sectors, causing widespread unemployment. Millions of hard-working Americans found themselves jobless, their dreams shattered, their futures uncertain. This was not a quick hit-and-rebound scenario. The recovery was long, arduous, and slow. The crisis was a wake-up call that exposed the vulnerabilities in our economic system. It revealed a system that was complex, interconnected, and fragile. The fallout shook consumer and investor confidence, and the economy went into a tailspin. The stock market plummeted, businesses closed their doors, and the American dreams seemed to be slipping away. In response, the government stepped in, taking unprecedented steps to stabilize the economy. The Federal Reserve slashed interest rates to near zero, hoping to stimulate investment and spending. Congress passed the Troubled Asset Relief Program, or TARP, to bail out struggling banks and prevent a complete financial system collapse. But these measures were not without controversy. Critics argued that the government was rewarding bad behavior and creating moral hazard. They feared that bailing out the banks would encourage reckless behavior in the future. Yet proponents countered that the alternative, a complete economic collapse, was far worse. Regulation also ramped up in the aftermath. The Dodd-Frank Wall Street Reform and Consumer Protection Act was passed to prevent a similar crisis from happening again. It increased government oversight of banks, imposed stricter capital requirements, and created the Consumer Financial Protection Bureau to protect consumers from predatory lending practices. The crisis and the government's response reshaped the American economy. It led to a more cautious and regulated financial sector. It changed the way businesses operate and how individuals manage their finances. It prompted a re-evaluation of what economic stability means and how it can be achieved. But the effects of the crisis didn't stop there. Over a decade later, we're still feeling the effects of the 2008 economic crisis. Let's start by looking at the wealth gap. Before the crisis, this gap was already substantial, but the financial upheaval caused by the crisis served to widen it further. The wealthy, with their diversified investments and assets, were able to weather the storm and recover much faster than middle and lower income households. These households, often with their wealth tied up in their homes, saw their net worth plummet as property values crashed. Today, the wealth gap is wider than it was pre-crisis, a stark reminder of the long-lasting effects of the 2008 economic downturn. Next, let's turn to the banking industry. The crisis led to a major shakeup, with some banks collapsing and others merging to survive. The ones that remained standing had to adapt to a new landscape, one with stricter regulations and increased oversight. This has resulted in a more cautious and risk-averse banking industry, with the focus shifted from high-risk, high-reward investments to more stable, long-term growth strategies. The era of unchecked speculation and risky financial products that led to the crisis is, for the most part, behind us, a significant long-term effect of the 2008 crisis. Finally, we cannot overlook the lasting economic uncertainty that the crisis has left in its wake. The recovery has been slow and uneven, with periods of growth often followed by setbacks. This has led to an atmosphere of economic insecurity, with many people unsure about the future and hesitant to make long-term financial commitments. The psychological scars left by the crisis are still evident, with trust in financial institutions and the economy at large yet to fully recover. So while the crisis may be over, its impact is still being felt today. The long-term effects of the 2008 economic crisis are profound and far-reaching, shaping the way we view and interact with the economy. The echoes of the crisis still reverberate, serving as a reminder of the importance of financial stability and responsible economic management. So, what have we learned about the 2008 economic crisis and its long-term effects? We've journeyed through the build-up to the crisis, a time of unchecked financial risk-taking and lax regulatory oversight. We've seen how these factors culminated in a devastating financial collapse as major institutions crumbled and markets plunged. We walked through the aftermath, a period marked by economic recession, massive job losses, and widespread financial hardship. We've seen the government's response, a controversial mix of bailouts, stimulus packages, and regulatory reforms. And we've delved into the long-term effects of the crisis. We've seen how it has fundamentally reshaped our economy, from the way we regulate financial institutions to the way we think about economic inequality. We've seen how the scars of the crisis are still visible today, in the form of sluggish wage growth, high levels of household debt, and a persistent lack of economic security for many Americans. We've learned that the 2008 economic crisis was not just a temporary setback, but a seismic event that has permanently altered the economic landscape. It's a cautionary tale of what can happen when financial risk is underestimated and regulatory oversight is lax. The 2008 economic crisis was a pivotal moment in our history, and its effects continue to shape our economy today. Despite the challenges it has presented, it has also offered us valuable lessons about the importance of financial stability and the role of government in maintaining it. Let's hope we've learned from it.